If you've ever thought about investing, chances are the same question has crossed your mind. Should I buy individual stocks or should I stick with ETFs? It sounds simple, but the choice between stocks and ETFs can completely change how your money grows and how much stress you feel along the way. Today, we're going to break it down in plain English, and by the end, you'll know exactly which path is likely better for you. So let's start with stocks. When you buy a stock, you're buying a slice of one company. If you buy Apple, you own part of Apple. If you buy Tesla, you own part of Tesla. It's direct ownership. The upside is clear. If the company grows, your shares can skyrocket. Early Amazon investors saw their wealth multiply thousands of times over. A single right pick can change your life, but here's the catch: stocks are risky. For every Amazon, there are hundreds of companies that fail, stagnate, or even disappear. And unless you have the time, skill, and patience to research deeply, picking stocks can feel more like gambling than investing. That's where ETFs come in. An ETF, short for Exchange Traded Fund, is like a basket. Instead of owning just one company, you own a slice of hundreds or even thousands at once. Think of the S&P 500 ETF. By buying just one share, you instantly own a piece of the 500 largest companies in the United States. That's tech, healthcare, banks, consumer goods all in one shot. The big advantage: diversification. If one company fails, it barely dents your portfolio because the others balance it out. Now, let's talk about fees. With stocks, once you buy them, you're done, no ongoing cost. With ETFs, there's something called an expense ratio. It's usually tiny, something like 0.03% per year for an S&P 500 ETF, but it's still a cost. For every $10,000 you invest, that's just $3 a year. Almost nothing, but it's worth knowing. So which grows faster? To answer that, we need to compare the reality of stock investing versus ETF investing. Imagine you buy one stock, say Tesla. If Tesla doubles, your money doubles, amazing. But what if Tesla crashed by 50%? Half your wealth disappears. That's the risk of concentration. Now imagine you put the same money into an ETF that holds hundreds of companies. Some will go up, some will go down, but the overall trend of the market historically points upward. Over the past century, the S&P 500 has returned about 10% per year on average. Not every year, of course, some years are down, even badly down, but long-term, it's been remarkably consistent. Think about Warren Buffett, the world's most famous investor. Even he has said that for most people, buying an S&P 500 ETF is the smartest move. Why? Because beating the market consistently by picking stocks is brutally hard. Study after study shows that over 80% of professional fund managers underperform the index over time. If the pros can't do it reliably, what are the odds a beginner will? But let's not dismiss stocks entirely. There's a reason people love them. With stocks, you can target specific companies you believe in. Maybe you think artificial intelligence will change the world, so you buy Nvidia. Maybe you believe in green energy, so you buy Tesla. With stocks, you get the excitement, the thrill, and sometimes the extraordinary gains that no ETF can match. That thrill, though, comes with a cost: volatility. Big ups, big downs, sleepless nights. So let's get practical. If your goal is to grow wealth steadily, avoid stress, and still get solid returns, ETFs are your best friend. They let you ride the growth of the entire market with minimal effort. If your goal is to chase big wins, accept higher risk, and you're okay with losing money sometimes, then adding some stocks might make sense. But here's the golden rule: if you choose to buy stocks, never put all your eggs in one basket. A portfolio built on both mostly ETFs with a few carefully chosen stocks and give you the best of both worlds. Now, let's circle back to the question: which grows money faster? In theory, an individual stock can explode and beat everything else. In practice, most people underperform because they pick the wrong ones, sell too early, or panic when prices drop. Meanwhile, ETFs quietly compound year after year, turning even small contributions into a fortune over decades. The average person will almost always do better with ETFs. To put this into perspective, let's imagine you invest $500 a month for 30 years. If you pick stocks and you're lucky enough to beat the market, maybe you end up with $2 or $3 million. But if you just stick to a low-cost ETF tracking the S&P 500, history shows you'll likely end up with over $1 million, maybe more, with far less stress. That's the power of consistency. So here's the bottom line. Stocks are a roller coaster, high highs, low lows, and no guarantees. ETFs are the steady escalator, slow and boring, but reliably moving upward. If you're a beginner, ETFs are almost always the smarter choice. If you want excitement, sprinkle in a little stock investing, but never bet the farm. Investing isn't about bragging rights. It's about building a future where you can sleep well at night knowing your money is working for you. The choice is yours, roller coaster or escalator. Which ride do you want to take?